All right, if you're an S-Corp owner, I want you to think of yourself less as just a business owner and more like a pilot. Your business's finances, that's your cockpit. And your tax strategy, well, that's the control panel, your financial dashboard. Today, we're going to show you exactly which levers to pull to save the most money. So, let's dive in.
So let's just get right to it with a really important question. As an S-Corp owner, are you leaving money on the table for the IRS? Look, it happens all the time, especially when you're busy just trying to run your company. But the great news is, this is totally fixable. We're going to walk you through how to make some smart, informed moves to keep more of your hard-earned cash right where it belongs, with you.
Okay, so here's our game plan for today. We're going to start by breaking down the whole S-Corp tax puzzle. Then we'll get into the real hands-on stuff, calibrating your salary, using benefits and retirement plans to your advantage, accelerating deductions on assets, and even mastering how to handle losses and gains. And finally, we'll wrap it all up by showing you how to be totally audit-ready.
You know, S-Corp Tax Optimization really is like a puzzle. It's all about seeing how the pieces, your salary, your distributions, your deductions, all interconnect. The secret here isn't some single magic bullet. Nope. The real win comes from knowing which levers to pull together to create the biggest impact on your bottom line.
All right, let's grab the most important control on that dashboard. I'm talking about your salary. Seriously, how you decide to pay yourself is the bedrock of your entire tax strategy. Getting this number right isn't just important, it is absolutely 100% crucial.
Okay, so the IRS has a really specific rule about this, and you can't get around it. You can't just pay yourself, say, $1 a year and then take everything else as a tax advantage distribution. It just doesn't work that way. You have to pay yourself what they call reasonable compensation, basically a fair salary for the actual work you do in your business. This is step one, and it is totally non-negotiable.
And this is where it gets tricky. It's a real balancing act. If you go too low with your salary, the IRS can come in, reclassify all those distributions as wages, and bam, you're hit with back taxes and penalties. Not fun. But if you go too high, you end up paying way more in payroll taxes than you need to, and you could actually be shrinking another huge tax break you're entitled to.
And this is that huge tax break I'm talking about. It's called the Qualified Business Income Deduction, or QBI for short. It's awesome. It lets you potentially deduct up to 20% of your business income right off the top. But, and this is a big but, it's calculated after your salary. So think about what that means. Every extra dollar you pay yourself in salary is a dollar that doesn't get included in that QBI calculation. It's all about finding that perfect sweet spot.
Okay, so once you've dialed in your salary, it's time to look at the next set of controls on our dashboard. Let's talk about how we can turn things you're probably already spending money on, like benefits and retirement, into some really powerful deductions that will bring your taxable income way down. You know, one of the easiest, most effective tools out there is something called an accountable plan. And don't let the name fool you, it's not complicated at all. It's just a formal way for your S-Corp to pay you back for business expenses you paid for out of pocket. Think mileage, a home office, stuff like that. When you do it right, the money comes back to you completely tax-free and the business gets to deduct it. It's a total win-win.
And look, it really is this simple. Step 1, put a written plan in place. Step 2, keep your records, receipts and logs. Step 3, the company pays you back for the exact amount. That is literally it. And the best part, no payroll tax, no income tax on that money you get back.
But it doesn't stop there. Your S-Corp can help out with other big-ticket items. I mean, think about health insurance premiums. That's a huge one for most of us, right? Or you can set up special accounts to reimburse medical costs. You can even get the company to pay for education. And, of course, the big one, retirement. Pumping money into a SEP IRA or a solo 401k is one of the best moves you can make. Every one of these is another lever for a valuable tax deduction. Okay, let's shift gears. What happens when you need to buy stuff for the business? Maybe a new computer, a company vehicle, or you're upgrading the office. Well, those aren't just expenses, they're opportunities. These investments can become powerful tools for creating big, immediate tax deductions that can make a huge dent in your tax bill for the year.
All right, let me introduce you to your new best friend, Section 179. This little piece of the tax code is incredible. It basically says that instead of slowly deducting the cost of new equipment over several years, you can often deduct the entire purchase price in the single year you buy it. If your business is making good money, this is like hitting the nitro button on your deductions.
But, hey, Section 179 isn't the only tool in the shed. You've got options. There's also bonus depreciation, which also gives you a big deduction up front. Or you could stick with the standard system, called MACRAs, to spread those deductions out over time.
As you can see, there's no single right answer. The best move for you really depends on how profitable your business is and what your financial goals are.
Okay, now we're going to move into some of the more advanced maneuvers on our dashboard. These next couple of strategies are super powerful, but they definitely require a bit more finesse. You got to be precise, especially when you're talking about a big sale or, a year where the business took a hit.
Let's talk about big sales. Timing is everything. Say you sell a major company asset. You do not have to take that entire tax hit all in one year. There's a strategy called an installment sale that lets you spread out the income and the taxes you owe on it over several years. That gives you an incredible amount of control over your tax.
So, what about the flip side? What happens when you have a loss? If your business has a rough year, it's natural to think, great, at least I can deduct this loss against my other income. But hold on, it's not quite that simple. The IRS makes your loss jump through a few hoops, like passing a series of tests, before you can actually claim it.
Think of it like 3 security gates your loss has to pass through. Gate number 1 is basis. This is basically your financial skin in the game, how much you've personally invested or loaned to the company. Gate 2 is the at-risk rule. This just means you have to have a real chance of losing your investment. And Gate 3 is passive activity. You have to actually be involved in running the business. Only if your loss makes it through all 3 of those gates can you deduct it.
So, we've gone over a ton of really powerful strategies. But here's the thing. None of them mean a thing if you don't have a solid foundation of great record-keeping and compliance. This is our final check, and honestly, it might be the most important part of managing your financial dashboard. And this really gets to the heart of it. The real savings come from pulling a bunch of these levers together. But you have to remember, these aren't loopholes. These are strategies with very strict rules and documentation requirements. Being audit-ready isn't something you do at the last minute. It's about following the rules from day one, every day.
So think of these as your compliance guardrails. You got to document your reasonable compensation analysis. Write down why you chose that salary. You need to track your stock and debt basis every single year. Keep meticulous records for your accountable plan expenses. File the right forms for things like depreciation. It's doing this stuff correctly that makes your strategy strong and, resilient.
All right, we've just given you a full tour of your S-Corp's financial dashboard. We've looked at salary, benefits, asset deductions, all of it. Every single one of those is a tax-saving lever just waiting for you to pull it. So, now the real question is, which lever are you going to pull first?